Welcome to the Stock Market Palantir. Today we are going to talk about DJT, the equity story of Trump Media and Technology Group Corp. in late 2025 is. It's arguably one of the most fascinating and certainly most complex plays in the public markets right now. We're watching a company that has executed a massive pivot under, just intense scrutiny. After hitting the public markets, the stock, DJT, has had a brutal year-to-date decline, something like 67%, and it's now trading stubbornly in that 10 to 11.50 range.
And that range is really the perfect starting point for our whole discussion because it tells us, almost everything we need to know. The current market cap is sitting right around $3.1 billion, which, and this is the crucial part, is almost exactly where the company's net asset book value is. The market has completely re-rated DJT. It has. It's fundamentally decoupled its valuation from traditional metrics like user growth or ad revenue. We are no longer debating a social media platform. We're discussing a shell company sitting on a pile of assets.
That observation frames our central question perfectly. We're asking whether DJT's structural metamorphosis, this extreme pivot into a diversified holding company, leveraging digital assets and prediction markets, represents a necessary and, I think, an incredibly shrewd long-term strategy for survival.
Or whether, and this is my firm belief, this high-risk financial engineering just confirms the underlying failure of its core operating business. It makes this pivot nothing more than a desperate defensive maneuver. My position is that this is really a concession of failure, a highly speculative distraction from some very deep-seated business problems.
And I'll argue that this strategic pivot, which is driven by some astute balance sheet management, is actually maximizing shareholder value from the available capital base in the most practical and, frankly, ingenious way possible. It secures the company's future regardless of how the social media side performs.
I see why you'd think that. I do. Because the numbers, at first glance, they can appear compelling. But let's look behind the curtain a bit. The Q3 2025 financial statements show a pretty stark operational reality. When you look at the expenses just associated with running the core platform, the company suffered a net loss of nearly $55 million. They have a persistent, completely unsustainable quarterly burn rate of over $50 million just to keep Truth Social operating. The platform just cannot stand on its own 2 feet.
That's an interesting point, though I would frame that financial picture very differently. This is where the strategic genius comes in. The company, through that initial SPAC mechanism, which for the listener essentially meant they merged with a blank check company that was holding guaranteed cash, amassed a massive $3.1 billion war chest. This capital base is what secures their survival, and management is using it to generate substantial passive income.
You call it passive income. I'd call it forced asset management.
Well, regardless of the terminology, look at the Q3 2025 operational cash flow. It was positive. It showed a surplus of about $10 million. So how can a company losing $55 million operationally show positive cash flow? Because that positive $10 million was driven by $13.4 million in interest income, which is just yield on their cash, plus another $15 million realized from some shrewd trading of Bitcoin option premiums. They are by design functioning as an effective $3 billion trust, generating yields that completely dwarfs the performance of their media business.
The very fact that their operational survival relies entirely on being a treasury trading desk is the definition of a failed core business model. And while we're on strategy, let's look at the next big move, the beta launch of Truth Predict, their prediction markets platform.
Truth Predict is both necessary and smart. It's a high-margin alternative to a failing low-margin ad model. We all know top-tier advertisers won't touch the platform because of brand safety concerns, so prediction markets, they solve the monetization problem by giving them a transactional revenue stream that gamifies the news cycle for their very engaged, politically focused user base.
That sounds great on paper, but I'm sorry, I just don't buy that the investment yield validates the fundamental business model. The market has delivered its verdict. The stock price trading near its cash value confirms that the market assigns zero, or maybe even negative, value to the Truth Social platform itself. And that pile of cash appraising is now being exposed to increasing, and I would say unnecessary speculative risk. I'm referring, of course, to the aggressive diversification into the Kronos or CRO utility token.
The CRO Treasury is all about creating optionality and maximizing the potential return on that war chest.
But it introduces massive, specific volatility. They bought a staggering 684 million tokens in Q3. And what was the immediate financial consequence? The company reported a non-cash loss of over $54 million in Q3 due purely to digital asset fair value adjustments. That one decision wiped out the quarter's interest income and just confirmed the extreme speculative nature of this pivot.
Okay, let's talk about that strategic choice because this is where our core disagreement really lies. The rationale behind the CRO Treasury strategy versus, say, the common approach, the MicroStrategy playbook of only holding Bitcoin.
Exactly. Why CRO over Bitcoin? I mean, Bitcoin is widely considered digital gold, a long-term store of value, even if it's volatile. CRO, however, is a utility token. Its value is entirely dependent on the adoption and transaction volume within the specific Crypto.com ecosystem. It is an unnecessarily complex, high-beta exposure to altcoins, not a treasury hedge. And on top of that, as of November 2025, we're in a persistent crypto bear market, which means this strategy is directly leading to immediate, palpable erosion in the company's book value.
I think you're confusing risk mitigation with maximizing leverage. The high volatility is precisely the strategic point. The CRO acquisition was remarkably capital efficient. They funded it using a relatively small commitment of about $50 million in cash, supplemented by $47 million in their own common stock. That modest outlay allowed DJT to gain massive high leverage exposure to the entire altcoin sector.
And massive risk.
Yes, but look at the potential upside. If the crypto market recovers and we see a massive bull run, which, many expected following the economic indicators this year, DJT maximizes its return on capital in a way the core social media business simply could never achieve. They're utilizing the cash base not just to survive, but to create a path to massive growth by hedging against their operational failures. It's a forced hedge, yes, but a smart one.
I just find the risk completely disproportionate. It's a gamble. Now let's move from the balance sheet risk back to the operational execution risk, which is centered on Truth Predict.
Well, we have to reiterate the necessity of Truth Predict. It solves two problems at once: monetization and engagement. By gamifying the political and news cycle, they tap directly into their highly engaged user base with a transactional revenue model that avoids all the regulatory and brand safety headaches of advertising. The key differentiating factor here is the exclusive partnership with the CFTC-registered Crypto.com Derivatives North America. That provides them with a crucial regulatory compliance pathway, positioning them as the only compliant onshore competitor against gray market platforms like Polymarket.
The compliance path is a definite advantage, I'll grant you that. But the execution risk remains enormous. The prediction market space is rapidly crowding. I mean, we have major sportsbook operators like DraftKings and FanDuel actively exploring entry. Their success relies entirely on achieving massive liquidity, meaning enough people betting on both sides of every single market to make it robust and accurate. That is incredibly difficult and expensive to achieve.
But their captive audience is already highly specialized and politically motivated.
Even so, analyst skepticism is extremely high about whether this feature, still in beta, can generate enough traction and sustainable revenue to meaningfully offset that core, persistent $54 million quarterly burn rate. And on top of that, we can't ignore the persistent, non-productive drains on capital, like the legal expenses, over $20 million in Q3 2025 alone, which continue to drag down both investor sentiment and the cash resources that should be funding growth.
Look, the legal costs are largely legacy issues stemming from the merger. They'll eventually abate, especially as SEC scrutiny eases. The investment in Truth Predict is forward-looking, and it's potentially transformative because it moves them from the ad-supported Web 2.0 model to a high-margin transactional model. It is a necessary disruption.
Disruption or distraction? Let's switch focus and talk about why the stock has traded down so aggressively. Because this leads to a common narrative we hear constantly from retail holders: the myth of dark pool suppression or market manipulation.
It is a pervasive theory, yeah. A lot of long-term shareholders simply cannot believe the price decay is organic, so they attribute the consistent decline to some hidden external forces.
And the market structure forensics from November 2025 strongly refute that narrative. We need to look at the off-exchange ratio, which tracks the percentage of trades executed away from lit public exchanges, the main, transparent markets. DJT's off-exchange ratio is roughly 33%.
Which, to an average person, probably sounds high.
But it's significantly lower than the typical market benchmark, which hovers around 45 to 50% for most large-cap stocks. What this data confirms is that the selling pressure is in fact organic and is happening transparently on public exchanges. The market is efficiently normalizing the price based on fundamentals and supply, debunking the entire dark pool conspiracy thesis.
I acknowledge the organic selling pressure, and I agree that the low off-exchange ratio debunks that specific theory. However, I would shift the focus from alleged manipulation to the structural supply issues that were equally devastating to the share price. The consistent downward pressure is primarily attributable to the June 2024 warrant redemption event.
That event was brutal, certainly. Can you clarify for the listener exactly why that moment created such a lasting effect?
Absolutely. Think of the warrants as a cheap coupon that the holders had from the initial SPAC merger. This coupon gave them the right to buy new shares at a fixed low price, $11.50 in this case. So when the stock was trading higher, these warrant holders exercised the right, bought the shares cheaply, and then immediately sold them at the market price. This wasn't just existing shares changing hands. This was the immediate creation of millions of new shares, pure dilution, which just flooded the market.
It's a massive supply shock.
Precisely. This action created what we call a heavy float. It permanently increased the number of shares readily available to trade, absorbing all available demand and liquidity. The stock became structurally heavier and much harder to move upward, regardless of positive sentiment. This structural event, the supply increase, is the major driver of the sustained price decay, not some conspiracy.
And that is a compelling argument. And that warrant dilution was undeniably a major shock to the float. However, if the stock was still truly constrained by a structural inability to move, if supply was overwhelming demand, we would expect to see corresponding evidence in the short market. We'd see extremely high short interest and a very high cost to borrow shares, indicating that short sellers are still actively fighting the stock.
And what do we see?
We see normalization. Short interest has stabilized around a moderate 8.9%. Not the extreme levels of last year. And the cost to borrow shares is minuscule, about 0.5% in late November 2025. This tells us two things. Shares are readily available to short, and that high-risk, hard-to-borrow constraint has completely eased. The market has normalized supply, confirming that the speculative short squeeze potential has drastically decreased, and price discovery is working exactly as it should.
Normalization, yes, but normalization around the company's net asset value, which again speaks to the market's ultimate recognition that the assets, not the platform, are the story.
We are in complete agreement there.
So as we look to wrap this up, I maintain my core position. DJT management has made the most of a bad situation. They maximized the available cash base raised during the SPAC boom to create an institutionalized hedge against their operational failures. They have purchased optionality through strategic, high-leverage assets, the cash yield, the residual Bitcoin options, and the aggressive CRO position. The company's financial survival is secured by the balance sheet, and any valuation upside now hinges entirely on external performance, namely the success of those speculative digital assets and the market adoption of Truth Predict.
And I reaffirm that this structural metamorphosis is a public acknowledgement that the core social media business has failed to achieve viability. The stock price reflects market rationality, valuing the company strictly as a high-risk investment fund, trading right near its net asset value of $3.1 billion. While the interest income is a pleasant side effect, the high risk and volatility inherent in the CRO treasury strategy, a choice I believe is fundamentally flawed, overshadow the modest operational gains and ultimately introduce more instability than security to the entity.
It is fascinating how completely the identity of this company has shifted in just a single year. The analysis really confirms the stock is no longer a political play centered on a media platform, but is now a speculative financial instrument.
Absolutely. The future trajectory hinges entirely on external factors, the crypto market and the success of Truth Predict adoption, rather than the engagement or advertising success of the social media platform that started the company.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.